and welcome to IIFL Markets. Today, we will understand how banks are likely to perform in the Q4 of this year. IIFL Securities expects the following trends from banking results in the fourth quarter. Credit and deposits. Credit growth for the banking system improved in the month of February 2021, even though the month-on-month trends remained a bit sluggish. Deposit growth too improved for the banks. Retail and services segment continued to drive overall loan growth amid subdued demand from the corporate segment, especially the large corporates. Overall, loan growth trends could stagnate in the quarter versus the Q3. Asset quality. Now, this is an important aspect to watch out for in this quarter results. As we know, the Supreme Court had lifted the asset classification standstill, which was extended to the banks to help them navigate through the turbulence caused by the pandemic. Now, this means slippages as well as reported NPAs could shoot up in case of some lenders. However, this development could lead to two key positives. One, a clear picture could emerge on asset quality trends for most of the banks, and lenders could push their recovery efforts even further. A large recovery in the steel sector could further aid earnings for a few big PSU banks. Profitability. We expect high earnings growth, especially due to a weak base in the March 2020 quarter. Large private banks could be at the forefront of earnings growth in the quarter. Net interest margin should remain flat with an upward bias on a sequential basis. This is because the interest reversals on the NPA recognition and decline in yields could be offset by lower cost of deposits and higher CASA ratios. Treasury gains could also be lower due to an increase in GSEC yields. Let us look at individual banks now. First up is SBI. Loan growth could improve to 9% on a YOY basis for SBI, which was around 8% on a YOY basis in the previous quarter. Asset quality should remain relatively stable on a sequential basis when compared to the pro forma numbers. This is despite higher slippages. Provisions would likely remain elevated, similar to the quarterly average over the first 3 quarters of this year. Profitability would be aided by the recovery in a large steel account. Key factors to watch out in the management commentary would be asset quality outlook, including collection efficiency trends. Next up is Hdfc Bank. There could be strong sequential growth in loans and deposits for Hdfc Bank at 4.6% and 5% respectively. Net interest margins are likely to remain stable on a sequential basis on the back of improving CASA ratio and lower cost of deposits. Yields, though, could be lower due to interest reversals. Notwithstanding higher slippages, the asset quality is likely to remain broadly stable when compared to pro forma across NPAs. We have to watch out for the management updates on the RBI directive to halt digital launches and sourcing of new credit card customers. Remember, the bank has been struggling on this aspect for a few months now. Commentary on trends in disbursements is also to be watched out for. ICICI Bank. Loan growth could pick up to 14% on a YOY basis from 10% which was witnessed in Q3. NIMs are likely to remain stable on a sequential basis. Slippages could spike on a sequential basis, though overall asset quality should remain stable when compared to the pro forma GNPA numbers. Provisions should moderate on a sequential basis as the bank has the option to use its COVID provision buffer. Key things to watch out for in management commentary include overall asset quality trends and rate of downgrade of loans rated BB and below. Bank of Baroda. Loan growth would be impacted by the decline in the international book for the bank. Margins could decline sequentially due to lower yields owing to interest reversals in the quarter. Higher slippages could be witnessed in the quarter, though overall asset quality is unlikely to deviate much from the pro forma ratios. Lower provisions, though, could fuel sharp increase in profits for Bank of Baroda. Axis Bank. Loan growth should moderate owing to high growth in the base quarter. Margins are likely to remain stable on a sequential basis. Slippages could surge on a sequential basis, though overall asset quality would be largely in line with pro forma ratios. Key management commentary to watch out for would be around collection efficiency and updates on downgrades with the loans rated BB and below. Thanks for tuning in. If you like this video, subscribe to IIFL Markets.